90% of financial advice focuses on the 10% of actions that have almost zero impact on long-term net worth. While the average person is told that skipping a $5 daily coffee is the secret to becoming a millionaire, the data suggests a much more mathematical reality behind true wealth accumulation. The Pareto principle, or the 80-20 rule, posits that 80% of results come from just 20% of efforts. In the world of personal finance, this translates to 3 specific, high-leverage decisions that dictate the trajectory of an individual's financial future far more than minor budgeting habits ever could. Over the next few minutes, an analysis of the specific choices that separate stagnant bank accounts from exponential growth will be conducted. Understanding how to optimize the 3 pillars of income, fixed costs, and asset allocation can shave decades off a retirement timeline. But here's where it gets interesting. In 1906, Italian economist Vilfredo Pareto observed that 80% of the land in Italy was owned by just 20% of the population. This distribution pattern has since been observed across various industries, showing that a small number of inputs consistently yield a massive majority of the outputs. When applied to a balance sheet, this means that most people spend 80% of their mental energy managing 20% of their capital. They obsess over grocery coupons or electricity bills while ignoring the massive leaks in their primary wealth-building engines that actually determine their financial destiny. For example, saving $10 a week on streaming services results in $520 a year. However, negotiating a 1% lower interest rate on a $500,000 mortgage can save over $100,000 in interest over the life of the loan. One decision requires daily discipline, the other requires one afternoon of research. The goal is to identify the big wins, those rare decisions that move the needle by hundreds of thousands of dollars rather than just a few cents. By focusing on these high-impact variables, a household can achieve financial independence with significantly less psychological friction. The data tells a different story about where the first big win starts. The first critical decision is the selection of an income vehicle. Studies from the Bureau of Labor Statistics show that the gap between stagnant and high-growth sectors is widening. A career choice in a high-demand field like specialized healthcare or technology can offer a starting salary that is 3 times the national median. Increasing income by 50% is mathematically superior to cutting expenses by 50%, as there is a floor to how low costs can go, but there is no ceiling on earnings. Statistics suggest that individuals who switch employers every 2 to 3 years see average pay increases of 10 to 20%, compared to 3% for those who stay. Consider the difference between a general laborer and a specialized consultant. Both may work 40 hours a week, but the consultant leverages a specific high-value skill that the market prizes. This leverage allows for the generation of a larger surplus, which is the raw material needed for wealth creation. Without a significant surplus, no amount of budgeting can create wealth. If the gap between what is earned and what is spent is too narrow, the engine stalls. Research indicates that the most successful wealth builders focus on increasing their hourly value rather than simply working more hours. But income is only half the battle. The second major decision involves the management of the largest recurring costs. When an individual manages to increase their income, the biggest threat to their success isn't the price of milk, it is the silent expansion of their lifestyle. This brings us to the most dangerous wealth killers in the average budget. The average American household allocates approximately 50% of its total budget to just 3 categories: housing, transportation, and food. Within the 80-20 framework, these are the only expenses that truly matter. If these 3 are optimized, the rest of the budget becomes statistically irrelevant to long-term success. Housing is the single largest expense for most people. Financial experts often suggest the 28% rule, where housing costs should not exceed 28% of gross monthly income. Choosing a home that is 20% below one's maximum budget can result in hundreds of thousands of dollars in extra investment capital over 30 years. Transportation is the second largest leak. A new vehicle loses approximately 15% of its value the moment it leaves the lot and nearly 60% of its value within 5 years. By opting for a reliable, used vehicle, a household avoids the dual wealth killers of rapid depreciation and high-interest auto loans. Data from the IRS and various financial institutions suggests that high-net-worth individuals often live in middle-class neighborhoods and drive older vehicles. This is not because they cannot afford more, but because they recognize that these are depreciating assets that consume the capital meant for growth. By keeping fixed costs low relative to income, a significant margin of safety is created. This margin allows for aggressive investing during market downturns. However, the final decision is where that margin is actually placed. Moving from saving to true wealth requires a shift in how one views the markets. The third and perhaps most vital decision is the allocation of the surplus. While many focus on picking the perfect individual stock, historical data shows that over 90% of a portfolio's returns are determined by its asset allocation, the mix of stocks, bonds, and real estate, rather than the specific timing of trades. A study by S&P Dow Jones Indices found that over a 15-year period, more than 90% of actively managed funds underperformed a simple index fund. For the average individual, the decision to use low-cost, broad market index funds is a high-leverage move that removes human error and excessive fees from the equation. Compounding works most effectively when it is not interrupted. Frequent trading and emotional selling during market volatility are the primary reasons individual investors underperform the market averages. The decision to remain time in the market rather than timing the market is the ultimate 80-20 move. Consider two individuals, one who researches stocks for 20 hours a week but earns a 7% return, and another who spends 10 minutes a year on an automated index strategy earning 10%. The latter person uses less effort to achieve a superior result, embodying the spirit of the Pareto principle. Wealth is not built by 1,000 small decisions, but by a few massive ones executed correctly. By focusing on career growth, minimizing fixed costs, and maintaining a simple, long-term investment strategy, anyone can leverage the math of the wealthy to secure their own financial independence. The most important takeaway is that 80% of financial success is governed by the big levers of income, housing, and asset allocation, not the minor details of daily spending. If this analysis changed how the math of money is viewed, the next breakdown on the specific mechanics of index fund compounding will provide the tactical steps needed to move forward.